Hello everyone, welcome to Mr. Corp's channel and our today's topic is solvency ratio. So before we dive into this topic, a quick introduction about myself. So I'm a member of ACCA Association of Chartered Certified Accountant and I also hold a master's degree in finance and accounting. I hold a 6+ years of experience in corporate finance and accounting roles in big MNCs and my skill sets are financial reporting, financial analysis, process improvements, standardization, advanced Excel, and stuffs like that. Let's quickly jump into the topic. I'll just zoom this a bit. Yeah. So, what is solvency ratio? Why is it important? Because it helps businesses and institutions to examine a company's financial health. How is the company financially? Okay. So, how we judge this? So, we judge this by knowing whether the company can meet its financial obligation in the long run. Okay. Whether the company has the ability to meet its obligation in the long run. Okay. Whether will be able to pay off the debts, the payables, the interest, and all other leases and everything. Okay. So that is what it helps companies and institutions to figure out. What are the advantages of solvency ratio, or who are the people who use this? The first set of people are lenders. Lenders are the one who provide fund to company to run their business, and these lenders want their money back along with the interest. So they are very keen into this ratio. Okay. Same are potential investors. Potential investors are the shareholders. If the lenders want say 6%, the investors would want 12%. Okay. Though it is not an obligation, but they do want that, right? So, yeah, so investors will also look into this ratio whether a company will be able to pay them back their money along with return or not. Now, suppliers. Next are suppliers because suppliers provide suppliers provide businesses with raw materials and supplies to make their product and sell it to the customers, right? But in general, with big businesses, suppliers provide long credit lines like 30 days, 60 days, 90 days. So they are also very much interested in solvency ratio, knowing whether their customers or the businesses in which they are dealing with be able to pay their money back on time or not. Okay. Now, there are certain companies which are profitable or which will be profitable, but may not have the ability to meet its financial obligations. Okay. So it is profitable, generating profits, but profit is not in cash. Okay. So in certain cases, making profit, but it has obligation, it won't be able to pay it, or it might struggle to pay its obligation or meet its obligations. Okay. So it helps not just simply rely on profits, but see, although the company is profitable, check the solvency of that company. So there it becomes important. Okay. Now, if the solvency ratio is high, then it is considered to be good. If it is low, then it is considered to be bad. Now, different types of solvency ratio, let's quickly look into those, what it is. First one and the most widely used one is debt to equity. Okay. Now, this is straightforward, debt by equity. So if I say my debt is $100 and my equity is $100 as well, then my debt to equity ratio will be 1x. Okay, means one time 100 by 100. Now this is the second ratio, which is a similar nature, which also is in uses debt and equity. So if we go by this one, the ratio will be 0.5x. How we arrive at it? 100, which is of debt, divided by 100 of debt plus 100 of equity. So the third one is equity ratio. Now, what this tells us? This tells us that how much of my total asset is funded by equity, which is TES, which is total shareholders equity by total asset. Now, this ratio can also be tailored into debt by total asset. So this will talk about how much of my total asset is funded by debt. Okay. Now the fourth ratio is interest cover ratio, which is linked to these. Okay. Because interest is dependent on debt. How much debt we have will figure out my interest rates. Sorry, my interest payments, right? So it is earnings before interest and tax by my interest expenses. So this is how it is. Now we have one example here, a balance sheet of Amazon Incorporation, and we'll use this to figure out our solvency ratios. We'll calculate our solvency ratios using this. Okay. Now let's figure out the different components. So where is my non-current liabilities, which is my long-term debts, non-current liabilities. Okay. So here it is, long-term lease, long-term debt, and other long-term liabilities. So these form my non-current liabilities. So these are the components. So we got our debt portion for our solvency ratio. Where is equity? Stockholders' equity. All these portions, all these components makes up my equity. Okay. Whether it is my whether it is my common stock, treasury stock, additional capitals raised, OCI, retained earnings, all these form my equity, total equity. And my total capital is here. So we got our equity, we got our debt. Now, where is my asset? So here is my total asset, which we need. So we got all the components. So I've summarized everything in a small table here below. So we'll use this to analyze the solvency ratio. Now let's come to equity first. If you see equity, equity is dropping, right? It is dropped by some 100K. Okay. Well, if you see debt, debt has increased significantly. Now, if these two are there, then what will be the impact on my debt to equity ratio? If you see, my numerator, my numerator is rising and my denominator is falling. Denominator is falling and numerator is rising, and the rise in uh, denominator, like my numerator, which is debt, is significant. Okay, my debt has increased way more, 10 times more approximately than my equity, which is bad. My total capital has increased overall, which we can see here. If you see my total capital has increased, but that increase is being contributed majorly by debt. The two ratios will be bad. See here, both are bad. Debt to equity is worsen, bad. Debt to total capital worsen, bad, right? Now let's capital. Now let's check or equity to total assets. Now let's see what is happening on the asset side. Assets are increasing, which is good, right? Which we considered good. Assets are increasing, good. But there's a concern. It is my assets are increasing. On the other hand, my equity is falling. However, my debt is increasing. What does it tell me? It tells me that the increase in my asset is actually being funded by debt. I'm using debt to fund my asset. Means my assets are being used as mortgage, right? That is why how I'm able to get more assets. My old assets have been pledged as collateral to get funds, and I bring in more assets. Something like that is happening, right? Which is not good for the business. That is why, if you see, my equity to asset ratio has gone bad as well. Okay, so this is how we analyze the ratios by looking to the different components and how different components play different role. Now, coming to, since we don't have the P&L of Amazon PLC Incorporation, we'll create a live example right here, and we'll also see how debt is linked to interest cover ratio. So just for example, let's see, say we have a debt at the rate of 10% per annum. The first year, say it is 100 million. The second year, say it is 120 million. Let's have equity here as well. Let's keep equity same and constant as well. Let's have earnings before interest and tax. Let's have it as 20 million, and let's keep this constant as well. Let's calculate our interest coverage ratio. So what it will be? EBIT, which is 20. What is my interest? Interest is 10. 10% of 100. So which gives me 2 times. Now, what my EBIT remains constant. My interest is 12. What it is 1.67 times. Okay. So if you see, oops, this is going bad. If this is going bad, it tells me clearly that my debt to equity ratio might have also gone bad. Let's check debt to equity ratio. Debt to equity ratio. What is my debt? Debt is 100. What is my equity? 100. 1. What is my debt here? 120. What is my debt? Equity 100. What is it? 1.2 times. So, yeah, the signal was correct. It has gone bad as well. So, this is how there is a link between these two ratios. Okay. Now, let's see some of the companies who have really high amount of debt. Okay. Won't take much time. I just quickly show you one or two companies. The first, at a global level, it is Toyota Motor Corporation, based on 2023 statistics, is having the highest amount of debt of $217 billion. Okay. And it has an annual revenue of 271. This is revenue, not even gross profit. Okay, this gross profit will be stripped to operating profit, which will be further stripped to net profit. Okay, then what will be left will, you can't see what is left after stripping so much. Okay, so next we know Evergrande Group, the infamous Chinese real estate company. Okay, it will be having huge debt, $174 billion in debt, with a merry $74 billion revenue, which is less than half of the debt. Incredible. Volkswagen, an automobile company, revenue of 299 and a debt of 166. Again, if we strip it down to net profit, can't see what it has to show you. Okay, now let's see some of the Indian companies. Okay, Adani Green Energy, debt. Now, all this debt amount which you see here is in million rupees. Okay, figure itself is in lakhs and millions, and then you need to put six more zeros. Okay, so that is how the number will look eventually. So Adani Green Energy, 5,42,710 million 10 million rupees. TVS Motor, 12 sorry 216 262 million rupees. SDFC, if you see, 58 lakh 22,649 million rupees. I find it difficult to even read those numbers. So this is the kind of debt these companies have, and still they're running successfully. How is it possible? The mantra is old debt, replace it with new debt, isn't it? This is what all these companies do to survive. And this cycle keeps going on. Okay, on and on. Okay, now let's look at some of the limitations of the solvency ratio. Okay, now this about what we talked about. Solvency ratio doesn't covers companies' ability to acquire new funding. Okay, all these multinationals will get funds to pay off their old funds. Oh, sorry, old debt, new debt to pay off their old debt, and the company runs. Okay, one disadvantage or one limitation. The next one is it simply measures the debt. Even if some company might not have debt or very less debt, but still it might be near to its insolvency because of poor cash management and increasing accounts payable. Okay, it is not solvent, but it doesn't have debt. So just looking at debt alone is not good. It need to be looked in conjunction with other ratios. Okay, also we already seen just in the solvency ratios there's so many ratios, and we can tailor it in different ways based on the requirement. Okay, so that makes it complex, and for its readers and the non-financial uh, people to understand these. Okay, so that is why it becomes difficult. Now if the company is moving towards its insolvency or struggling with its solvency, how will it bounce back or come back to making profits and generating cash and paying its debt on time? So the first and the foremost thing is reduce debt. Reduce it as much as you can. Sell your old assets, sell the assets which are not in use, sell the plants which are not in use, sell those business lines which are not generating money, which is running into losses, and pay off your debt. Be debt free, less debt. Okay, then start generating cash. So prioritize your debt. Okay, the debt which needs to be paid early. How are you going to pay early? Look for opportunities, look for those rooms where you can make money by selling something or the other. Okay, not everything, things which don't add value. Okay, restructure your debt and negotiate better payment terms. Restructure your debt means you have a loan which you need to pay in 10 years. Talk to the bank lenders, make it 15 years. Okay, so you have a longer runway. Your EMIs gonna come down. Okay, so you will be left with some additional cash to meet your other obligations. Negotiate better payment terms if possible, reduce the interest rate. Okay, to the banks, talk to the loan providers, cut unnecessary cost, overheads, luxury spends on luxury items, luxury services, and all those kind of things. Cut down on those cost and reduce your debt obligation, reduce your payables basically. Increase your cash flow, increase your customer base. Okay, increase the average amount of your customer spend. Now increase your customer base. Take your existing product to the new market. Okay, so you have newer customers. Bring in a newer product to the existing market. So you have two products consumed by same customers. Okay, so customer base increases. Okay, your product increases. So this is how you generate more cash. Increase the number of time the customer makes purchases. Okay, okay. So increase. So if the customer comes to you once a month, bring up strategies so that customer comes twice a month. Okay, all those things. And the last one I would say is raise prices. This is very strategic. This can either make your business or break your business. So that is why I've kept it at the very last. Okay, so very strategically this needs to be done. Okay, even rising prices, okay, can generate more money for you, or it can reduce because there are other businesses in competition, or sometimes even reducing prices can generate more money for you. The same reason, because of the competition. Okay, on a per unit basis you might be generating less revenue, but at an overall basis your volume increases, and due to which you make more revenue. Okay, so that is it for today's topic. Thank you so much. Please do like and subscribe and leave your valuable comments. Thank you so much.